Welcome back to Talk Tickers. This is the show for the experienced investor, the place where we strip away the PR fluff, ignore the noise, and get straight to the numbers that actually move markets.
And today we have a big one, a really big one.
If you've been watching the software sector lately, you know the vibe. It has been, well, it's been tense.
Tense is putting it mildly. It felt like a funeral procession. The market was absolutely terrified of the death of SaaS narrative going into this HubSpot print.
It really was. It was the elephant in every room, the topic of every Substack, and the fear driving every short seller.
And we really need to set the scene here because the context is everything. For the last, 3, maybe 6 months, the dominant story was that AI was about to just completely hollow out the software industry.
Exactly. The narrative was incredibly seductive, wasn't it? It was so simple, so logical.
It was. It went like this. AI agents are essentially free, or becoming free. Open source models are getting commoditized.
So therefore, software margins have to go to zero. Why would you pay HubSpot or, Salesforce $100, $200 a month for a human user's seat?
When an AI agent can do all the work for pennies on the dollar.
And if you don't need the human, you don't need the seat. And if you don't need the seat, the entire SaaS business model, arguably the greatest business model in the history of capitalism, is dead.
That was the fear, the deflationary tsunami thesis. And honestly, it's not a dumb thesis.
No, it's not.
If you look at the raw cost of generating code or generating an email or, summarizing a document, it has plummeted. It is a race to the bottom on cost per unit of output.
So the market looked at HubSpot, a company that sells seats to marketing and sales professionals, going into this Q4 2025 print and said,
dead man walking.
They were pricing in a funeral. The stock closed the regular session around $209. It was beaten down. Sentiment was just in the gutter.
And I want to pause here because this is so important for you to understand. This wasn't just about HubSpot. This was a referendum on the entire B2B software economy.
Yes, a bellwether.
If HubSpot missed, if they showed even a crack in the armor, any sign that AI was cannibalizing their seat count, the whole sector would have capitulated. It would have been a bloodbath.
Investors were just waiting for confirmation that the end of software had finally begun. And then the PDF drops. The numbers hit the wire.
And let's just cut to the chase. The market was wrong.
Dead wrong.
At least for now, completely and totally wrong. It wasn't a funeral. It was, maybe not a coronation, but it was certainly a proof of life.
A very loud proof of life. I mean, let's just look at the price action because that tells you everything you need to know about the sentiment shift. The stock pops, 4% after hours?
Which is fine. That's a standard beat. Nothing crazy.
Right. But the real story is the next day, the confirmation. A massive 9.37% rally to close near $229. And this wasn't on thin air.
No, this was on heavy volume. Over 7 million shares traded.
That volume is the key.
Right.
That is not retail traders chasing a meme stock. That is institutional capitulation.
100%. That is big money pension funds, hedge funds, all realizing at the same time that they were on the wrong side of the trade. That is a relief rally combined with a statement from a major platform saying, we are not dead. In fact, we are evolving.
So today we are doing a deep dive into this quarter, and we're not just going to read you the press release. We are going to unpack the existential shift happening at HubSpot. We're going to talk about the transition from software as a service to services software.
Which is a brilliant way to frame it. It completely changes the unit of value you're selling.
We're also going to look at the financial geometry, why the guidance looks a little soft on the surface, but might actually be a coiled spring.
And we have to talk about the death of SEO and the birth of something they're calling AEO.
And of course, we'll wrap it all up with our signature "This is not financial advice" segment, where we pitch a wild but plausible trade based on what we're calling the vibe coding thesis.
I love that term, vibe coding. We will absolutely get to that.
But first, you got to eat your vegetables. Let's get through the headline financials because you need to know the baseline before we can get into the grand theory of it all.
Right, the beat itself.
Let's start with the top line. Revenue came in at $846.7 million. That is up 20% year over year.
And let's put that in context. Beating the consensus estimate by nearly $16 million.
$16 million. I mean, in this macro environment, for a company of this scale, that is a very, very healthy beat.
It's heavy lifting. 20% growth at nearly $1 billion a quarter is not easy. That shows real demand, real execution.
Absolutely. Now let's look at the bottom line. Non-GAAP EPS came in at $3.09. The street was looking for $2.99.
So a solid dime beat. But here is what I found fascinating, and this is where you start to see the real discipline kicking in.
Go on.
If you look at the GAAP reality check, because we always look at GAAP, we don't just swallow the adjusted numbers. Hold GAAP net income was $54.4 million.
Which works out to about $1.04 per share.
So you've got this big spread, 309 non-GAAP versus 104 GAAP.
It is a big spread. What's that telling you?
It's telling you there is still heavy stock-based compensation, which is, it's pretty typical for the SaaS sector. It's how they retain talent. However, the cash flow is real.
And that's the key. That's what allows them to make all the moves we're about to talk about.
Which leads us perfectly to the efficiency engine. This is the part of the story that I think really got the institutional money off the sidelines and back into the stock.
The margins.
The margins. Operating margins on a non-GAAP basis hit 22.6%.
And that's up significantly. It was 18.9% a year ago.
And that right there is the critical narrative shift. If you go back 3 or 4 years, the knock on HubSpot was always profitability. Great growth story, but were they efficient? Were they ever going to print real cash?
Right, the growth at all costs mindset.
Exactly. And now they are balancing 20% revenue growth with massive profitability expansion. They are not burning cash to grow anymore. They are scaling leverage.
It's the rule of 40 on steroids. I mean, 20% growth plus 22% margin, that's 42. They're well above that benchmark for a healthy SaaS company.
They are. And it signals a maturity in the management team. They understand that in a high interest rate environment, money isn't free. You have to show you can generate cash. And they're generating mountains of it.
Speaking of generating cash and showing confidence, we have to talk about the credibility signal.
The buyback.
The board authorized a $1 billion share repurchase program to be executed over the next 24 months.
This is huge. For a growth company to authorize a $1 billion buyback.
Yeah.
I mean, that sends a very, very specific message to the market.
But let me play devil's advocate here for a second.
Go for it.
Isn't a buyback just an admission that they've run out of better ideas? Usually, when a tech company starts buying back its own stock, it's a signal that says, we don't know how to invest this cash into R&D to grow even faster, so we'll just give it back to shareholders through financial engineering. Is this actually a bearish signal disguised as a bullish one?
That's the cynical take. And, in many cases, I'd probably agree with you. If this was a company growing at 5%, I'd say yes, they're just trying to engineer their EPS higher.
But that's not what's happening here.
Not at all. HubSpot is growing at 20%. They are investing heavily in AI, in R&D. So in this specific case, the message is completely different.
What's the message then?
The message is, we think our stock is cheap. Management is effectively saying, we look at our internal cash generation. They're targeting something like $740 million in free cash flow next year. We look at our product pipeline, we look at where the stock is trading, and we see a massive arbitrage opportunity.
So it's an allocation of capital decision. They believe the best return on investment right now is their own stock.
Exactly. It signals that they believe the stock is undervalued at these levels relative to their future cash flows. It puts a floor under the stock price. It's a direct message to the shorts, saying, if you push us down any further, we will just absorb the float.
It's a flex. It's definitely a flex. Okay, let's look at the guidance quickly before we go deep. Q1 2026 revenue guidance, they're calling for $862 to $863 million.
And for the full year 2026, it's looking like $3.69 to $3.70 billion.
Which works out to roughly 18% growth, and margins are targeting about 20% for the full year.
Right.
Now, you might look at that 18% guide and say, wait a minute, they just did 20% growth. Is that a slowdown? But if you read between the lines, and we will unpack this in detail later, the guide actually implies an acceleration throughout the year.
It does. It's a setup, but we'll get to why it's a setup in our financial geometry section.
Okay, let's get into the meat of this, the deep dive. Part 1. The AI pivot, or as I like to call it, output versus outcomes.
This is the philosophical heart of the entire earnings call. This is where they win or lose the war for the future of SaaS.
Yamini Rangan, the CEO, she laid out a thesis that I think is essential for every investor in this space to understand. The market fear, as we said, is that AI makes software a commodity.
Right. If I could just ask ChatGPT to write a marketing email, why do I need to pay for HubSpot's Marketing Hub?
That's the output argument. AI generates output words, images, code at a near zero marginal cost. It just generates stuff.
But Yamani's defense, her entire argument, is built on something she calls the context layer. She argues there's a massive unbridgeable gap between AI output and AI outcomes.
And this is a crucial distinction. Output is just pixels on a screen. It's a nicely worded email. Outcomes are business results.
Leads generated, deals closed, support tickets resolved, things that actually impact a P&L.
Okay, hold on. I want to challenge this outcome versus output thing because it sounds a little bit like classic CEO consulting speak. You know, every company says they focus on outcomes. How is this actually a technical defense against AI commoditization? Yamini is saying we have the context layer. What does that actually mean in practice?
So let's strip away the buzzwords. Think about how a large language model works at its core. It's a probability engine. It's a fancy autocomplete. It predicts the next most likely word in a sequence.
Right.
So if I ask ChatGPT to write a sales email, it gives me the statistical average of every sales email it was trained on.
Which is usually generic garbage. I hope this email finds you well. I get about 100 of those a day.
Exactly. It's output. It's words. But here is the fundamental problem. The model doesn't know who you are. It doesn't know your business. And most importantly, it doesn't know your customer. It doesn't know that your prospect, let's call him Steve, opened your pricing page 3 times last week, but completely ignored your last 2 emails about leveraging synergy.
Okay, so the LLM is incredibly smart, but it's completely blind. It has no memory of the relationship.
It's blind to the state of the relationship. That is the context layer. HubSpot is arguing that the value isn't in generating the text. Generating text is now a commodity. It's cheaper than water. The value is in the metadata, the history, the context surrounding that relationship.
So the moat is the data, the historical record of every interaction.
It's the history plus the logic. They visualize this as a 3-layer stack. You've got the context layer at the bottom, that's the data fuel, the CRM. Then you have the action layer in the middle, that's the AI agents doing the work. And then critically, you have the coordination layer on top.
Okay, but let me play the bear case here again. This is what the shorts are arguing. Why can't I just export all my HubSpot data into a CSV file, feed it into a custom GPT that I build, and say, hey, here is Steve's entire history. Now write the perfect email. Why do I need to pay HubSpot for that last step? This is the data vampire theory, that we just suck the data out and leave the empty husk of the software.
That is the trillion-dollar question right now. And Yamini had a very, very strong counter-argument to this on the call. She said sauce isn't just a database. Sauce is, and this is a great phrase, non-deterministic logic flows.
Whoa. Okay, English, please. What does that mean?
Laughs. Okay. Think about your actual sales process. It's not just a list of names in a spreadsheet. It's a flowchart. It's a series of if-then statements.
Right.
If Steve clicks the pricing link, wait 2 days, then send him the case study. But if he's a VP at a Fortune 500 company, don't send the email. Route him directly to Mary, our top enterprise sales rep. But if he's an intern, just send him an automated ebook and put him in a nurture sequence.
That's workflow. That's business logic.
That is logic. It's workflow. And you can't easily export workflow into a chatbot. You can export the names in the emails, but you lose the process. HubSpot's core argument is that businesses run on process, not just on data. If you move your operations to a raw, generic LLM, you lose the guardrails, the permissions, the routing, the approval chains. You lose the coordination layer.
So the defense is, we have the context, and we own the logic that acts on that context. Therefore, we own the outcome.
Precisely. And if they own the outcome, they can charge for it. They can charge a premium for it.
Which leads us perfectly into part 2 of this deep dive, the rise of the agents and how they are actually starting to make money from this. Because for a long time, AI was just a buzzword on a slide deck. Now we have real numbers.
We do. And the star of the show, without a doubt, is the customer agent.
This one really blew my mind. Over 8,000 customers have activated the customer agent. But the metric that truly matters isn't the activation number, it's the resolution rate.
Mid-60% resolution rates.
Let's just pause on that for a second. That means AI is solving 2/3 of all incoming customer support tickets without a human ever touching them.
Think about the unit economics of that for the customer. If you are a business, your single biggest cost center in customer service is headcount. Your support costs just plummeted.
But for HubSpot, this is the pivot. This is service as software. They are no longer just selling you the seat for the human support agent to sit in. They are selling you the work that the support agent used to do.
And this is where the monetization model gets so interesting. They are shifting to a credits model. This is the sleeper hit of the entire earnings call. I think a lot of people just glossed over this because they were so focused on the headline revenue and EPS numbers.
But the credits model is the future of their entire pricing strategy. It's usage-based pricing for AI work.
It untethers their revenue from human headcount.
We have to talk about the golf story. Because amidst all the financial tables and the jargon, there was this one little anecdote that I think explains the future of the company better than any P&L statement ever could.
The Skytrack example, it's perfect.
Right. So Skytrack is a golf technology company. They decide to pilot the new HubSpot customer agent. Now, usually when you buy software, you buy a seat. You pay for the year. It's a fixed sunk cost.
Right. Very predictable.
But HubSpot is moving to this credits model for AI work. So Skytrack buys a starter pack of 10,000 credits.
Which they probably thought would last them a month. Maybe a quarter if they were lucky.
It lasted 4 hours.
4 hours.
The AI agent just started handling tickets, answering questions from their website, resolving issues. And it was so voracious, so effective, it burned through their entire budget before lunch on the first day.
Now, in a normal company, the CFO walks into the marketing department and starts screaming, "Turn it off. What are you doing? You're over budget."
But that's not what happened.
No. They looked at the outcome, they had a meeting, and realized, wait a minute, these aren't wasted credits. Every credit spent represents a resolved ticket. These are happy customers who aren't clogging up our phone lines anymore. This is an incredible ROI.
So they didn't shut it off. They immediately went back to HubSpot and bought another $50,000 worth of credits.
And this, right here, this is the pivot point. This is service as software. You have to understand how monumental of a shift this is for the business model. For 20 years, SaaS revenue has been capped by human headcount. If Skytrack has 10 support agents, HubSpot can only sell them 10 seats. That's the ceiling.
Their revenue is literally tethered to human inefficiency and scale.
Exactly. But with the credits model, the revenue is tethered to work done. If Skytrack's customer base doubles, they don't need to go out and hire 10 more expensive humans. They just buy more credits from HubSpot. The ceiling is gone.
It creates uncapped elastic upside.
It creates what we call volume-based elasticity. And this is why the death of SaaS narrative might be completely wrong. They think AI reduces the seat count. And you know what? It might. Some companies might go from 10 support seats to 5.
But if the credit consumption from the AI agents outpaces the revenue loss from those 5 seats, the company actually grows faster.
It's the Jevons paradox. It's a classic economic principle. As you make a resource, in this case customer support, cheaper and more efficient, the total demand for that resource goes through the roof.
Right. And they gave a breakdown of the usage. They mentioned the customer agent is about 60% of the credits being consumed right now. The data agent and the prospecting agent are about 10 to 15% each. So support is the clear killer app at the moment.
Which makes total sense. Support is reactive, it's high volume, and it's mostly text-based. It's the perfect training ground for these agents.
But the prospecting agent, the one doing the sales outreach, that's the one I'm watching for the real explosive upside.
Why that one specifically?
Because that directly drives revenue for the customer. Support cuts costs, which is great. But prospecting makes money. And if the prospecting agent really works, and they said on the call that customers using it book nearly twice as many meetings, then the willingness to pay for those credits will be even higher, even more inelastic than for support.
It's the difference between a vitamin and a painkiller. A cost cutter is a vitamin. A revenue generator is a painkiller.
It's, I will pay you $1 to make me $5. You make that trade every single time. That corporate wallet opens instantly.
Okay, that makes sense. Let's move to part 3, the death of search, or as I called it earlier, the death of SEO.
This is the macro problem that every single marketing department on the planet is grappling with right now.
It is the elephant in the marketing room. Traditional inbound marketing is dying. I hate to say it as someone who grew up professionally on it, but it's true. Search traffic is down across the board.
And the reason is simple. People are asking ChatGPT instead of Googling.
It's the zero-click future we've been talking about for years. If the AI just gives you the answer directly in the chat interface, you never click the link. If you don't click the link, you don't visit the website. If you don't visit the website, you don't fill out the form. The entire inbound funnel is broken at the top.
Gartner confirms this. All the third-party industry data confirms this. Inbound traffic is harder and more expensive to get than ever before. So the big question is, how does HubSpot, the company that literally invented the concept of inbound marketing, survive the death of their own creation?
They pivot. They pivot to AEO, Answer engine optimization.
I love this acronym, AEO. It's so smart.
It's brilliant. Instead of optimizing your website for Google's web crawler, you now have to optimize your content to be included in the large language model's training set. The goal is to be the most visible CRM and LLM-generated answers.
So it's about becoming a source of truth for the AI itself.
Exactly. But more importantly, they are pushing their customers to diversify their lead channels. They mentioned on the call that newsletter-generated leads are up 53%. YouTube leads are up 68%. They are actively trying to move their customers off of their heavy reliance on Google.
They call it the loop. It's their new playbook for marketing in the AI era. And they gave some specific customer examples to back it up. There was a company called Daibo, an AI learning platform.
Right. They saw their organic search traffic drop. Classic symptom of the AI shift. They felt the pain. They switched to HubSpot's AEO strategies, and now they're getting 13% of their leads directly from AI-driven sources.
And Crunch Fitness was another one they mentioned. They are sending 15 million personalized emails a month. That's not relying on search. That's direct engagement with your audience.
The big takeaway here is that HubSpot isn't just a passive victim of the AI disruption. They are actively selling the cure. They are going to their customer base and saying, hey, are you terrified that your Google traffic is drying up? We have the tool set and the playbook to help you survive and thrive in a ChatGPT world.
It's a very, very smart narrative flip. Instead of the story being AI kills HubSpot, the story becomes HubSpot helps you survive AI, and frankly, it's necessary. If they didn't have a credible solution for this problem, the churn would be massive.
Speaking of churn and retention, let's look at the financial geometry in part 4. This is for the nerds in the audience, but it's incredibly important for understanding the health of the business. The upmarket march.
It starts with net revenue retention, NRR. The magic number for any SaaS business. It came in at 103.5%.
And that's up from 101.8% in the prior period, and they expect it to hit 105% in Q1 2026.
In this economic environment, seeing NRR tick up is a profoundly bullish signal. Most SaaS companies are seeing their NRR compress because their customers are laying people off, buying fewer seats.
So why is it rising for HubSpot? It's not just price hikes, which is the easy way to do it.
No, it's something they call seat consolidation. And this is where their big pricing change from last year is finally paying off. You remember, they removed the seat minimums, but they introduced this new concept of the core seat.
Right, which was controversial at the time.
It was. But the result is that 90% of their legacy customers have now migrated to the new model. And contrary to the market's fear that companies would use this as an opportunity to buy fewer seats, the opposite is happening. Customers are buying more seats, specifically sales and service seats, because the value of the integrated platform is higher.
And they're winning much bigger deals. This really debunks the old idea that HubSpot is just for the local flower shop or the two-person startup.
The data on this is staggering. Their number of customers with over 500 seats grew fivefold, 5x growth in the large enterprise segment. And deals with a value greater than $10,000 grew 41%.
Let's be clear about what that means. They are winning enterprise consolidation deals against Salesforce. That is what that data is telling you.
100%. They are walking into large companies that are using Salesforce for sales, maybe Zendesk for support, and Marketo for marketing. And they are saying, look, we can do all of this on one unified platform with one single data model for 30% less cost.
And in this macro environment where every CFO is looking to cut costs and complexity, that consolidation pitch is a killer. It's winning.
It's the platform thesis playing out in real time. Multi-hub adoption is real. They said 62% of new Pro Plus level customers land with multiple hubs from day one, and 40% of their entire install base now has 4 or more hubs.
They aren't just a CRM anymore. They are becoming the central operating system for a customer's entire go-to-market motion.
Which makes them so much stickier. If your business is running on 4 different HubSpot hubs, you are not churning. It would be like performing open heart surgery on your company to rip it all out.
The switching costs become astronomical.
Okay, let's shift gears to the investor context. We have to address the vibe coding threat directly.
We touched on it earlier, but we need to go deeper on this because it's a real fear.
So for those who don't know, vibe coding is this emerging idea that you can just vibe with an AI, prompt it in natural language, and build custom software on the fly. Hey AI, build me a CRM. Hey AI, build me an HR system.
And the fear is that if software becomes that easy to build, the value of buying software goes to zero. Why would I pay HubSpot a subscription fee if I could just build BobSpot in an afternoon for free?
Dharmesh Shah, the founder and CTO, he laid the smackdown on this during the Q&A part of the call. And Dharmesh is an engineer's engineer. He didn't dismiss AI coding. In fact, he embraced it. But he made a key distinction about where engineering talent is actually deployed in a real company.
He said the best engineering calories at top companies are spent on creating unique customer value, not on reinventing the wheel.
Exactly. Just because you can code a basic HR system with AI doesn't mean you should. Do you want to be the one to maintain it? Do you want to handle the security updates when a new vulnerability is found? Do you want to build the mobile app for it? Do you want to make sure it's compliant with GDPR in Europe and CCPA in California?
It's the classic buy versus build debate, but on steroids. At the end of the day, you want the platform's reliability. You want their security team. You want their continuous updates and new features. HubSpot's own engineers, he said, use AI for 97% of their code commits.
That is a wild statistic, 97%.
So they're becoming hyper-efficient. But that efficiency improves their margins and their feature velocity. It doesn't mean their customers suddenly want to stop buying finished software and start maintaining their own fragile, home-brewed code bases.
It's like electricity. Just because I can go out and buy a generator for my house doesn't mean I want to disconnect from the public grid. The grid is convenient, it's reliable, it just works. HubSpot is the grid for go-to-market teams.
That's a great analogy. The total cost of ownership, the maintenance cost of vibe coding your own mission-critical CRM is effectively infinite. The maintenance cost of HubSpot is, well, it's the subscription fee. And for almost every company, the fee is cheaper than the headache.
Now let's talk about sandbagging. The CFO, Kate Bucher. Is she playing games with the guidance?
She's doing exactly what a good, experienced public company CFO should do. She is setting the bar at a height she is very confident she can clear.
The guidance starts at 16% growth for Q1, but the full-year guide implies an average of 18%.
The math is simple. That math implies an acceleration in the back half of 2026. To get the average up to 18, the growth rate in Q3 and Q4 has to be higher than 18.
So is she banking on the economy getting better or their product execution getting better? What's the source of that expected acceleration?
She's banking on the credits revenue kicking in. That's the big unknown variable. She can model seats easily. Seats are linear and predictable, but credits are volatile. If more and more companies have that Skytrack moment we talked about, where they suddenly burn through a month's worth of credits in 4 hours, the upside to revenue is massive and nonlinear. But she can't promise that to Wall Street yet. So she guides conservatively on the known business and treats the credit revenue as upside.
It's a setup. The bar is low enough to beat, which creates a positive news cycle and upward momentum for the stock.
And with the $1 billion buyback in her back pocket, she has a mechanism to support the stock if there is any wobble along the way.
Yeah.
It's a very, very tightly managed financial narrative.
Okay, we've covered the beat, the AI pivot, the death of search, and the financial geometry. Now, it is time for my favorite part of the show.
Oh boy. Here we go.
It is time for our signature segment. This is not financial advice.
And let me just say the full disclaimer, we are not financial advisors. Do your own due diligence. This is for informational and entertainment purposes only. Please do not sue us if you lose all your money.
Exactly. But if I were a hungry hedge fund analyst pitching to my portfolio manager right now, based on everything we just heard on that call, here's the trade I would pitch. I'm calling it the agentic volatility straddle. Or, if you want to catch your name, the lazy coder long.
Okay, I'm intrigued. Lay it out for me. What's the setup?
The setup is that the market, and specifically Wall Street analysts, still doesn't know how to price credit consumption. Right now, if you look at their models, they are forecasting linear growth based on seats. They're looking at headcount data, employment trends. They're saying, okay, unemployment is steady, so seat growth will be steady.
That's the traditional model. It's the safe, conservative way to model a SaaS business.
But the Skytrack effect completely changes the physics of the model. If companies start burning their monthly allotments of AI credits in a matter of hours, revenue will not be linear. It will be exponential. And it will be incredibly volatile. You're going to have these massive revenue spikes in quarters where customers suddenly lean into a new AI agent that works really, really well.
Okay, I see the thesis.
Yeah.
So how do you trade that potential volatility?
The trade is long deep out of the money, or OTM, call options on HUBS, the ticker, for Q3 or Q4 of 2026.
Why that far out? Why Q3 or Q4?
Because that's when the credit blowout happens. You need to give the credit model time to ramp up and surprise people. The core thesis is that you are betting on a single quarter where they don't just beat revenue by a little bit, they beat by 5 to 10%, and it's solely due to AI consumption overages. We are betting that HubSpot's AI agents will accidentally spend their customers' budgets faster than the customer CFOs can control it.
So you're basically betting on a temporary lack of governance.
I'm betting on the addiction to outcomes. Once a VP of sales sees that the new prospecting agent is booking twice as many meetings, they will tell their team to leave the PAP running. They won't care about the budget in the short term. And that will lead to a shock revenue beat that forces a massive re-rating of the stock. The narrative will shift overnight from HubSpot being a SaaS multiple stock to an AI infrastructure multiple stock.
That is actually plausible. It's a high-risk, high-reward bet on a paradigm shift in monetization. It's dangerous, but plausible. Do you have a hedge on this trade?
Of course. You always have a hedge. The hedge is to go short a basket of single-point AI wrapper tools or private market proxies if you can get access to them.
So you mean the companies that are just providing the output layer, the commodity?
Exactly. Short the output providers who are just thin wrappers around an open AI API. Long the outcome platform that has the data, the workflow, and the customer relationship. It's the output versus outcome trade expressed through options.
I have to admit, the agentic volatility straddle has a very nice ring to it.
It's spicy, but that's why we're here, to find the spicy trade.
Again, not financial advice. Please do not mortgage your house to buy deep out of the money call options.
But if it prints, you heard it here first.
All right, let's wrap this entire deep dive up.
The recap is simple. HubSpot beat the numbers, they raised the guide, and most importantly, they proved that the death by AI narrative is, at the very least, premature.
The fundamentals are elite. Margins are at 22% and climbing. They are buying back $1 billion in stock. This is a quality company executing at an extremely high level in a difficult environment.
And the key takeaway for you, the listener, is this. The transition from seats to credits is the most important thing to watch in 2026. If you are tracking this stock, stop looking at your old models based on headcount growth and start trying to figure out credit consumption. That is the new heartbeat of this business.
It's a fascinating evolution. We are watching a major SaaS incumbent morph into something completely new right in front of our eyes.
And if you aren't paying attention to that shift, well, then you might as well just be generating output, not outcomes.
A very nice callback to end on.
Thanks for tuning in to Talk Tickers. Remember, always use context to drive your trades. We'll see you next quarter for the next deep dive.
See you then.